My name's Christine Hargis, and I'm an analyst here at The Motley Fool, and I'm here to teach you how to invest in stocks. But first, a question we often get: why should I invest in stocks? The answer: because the stock market holds the key to incredible wealth. Consider that stocks have historically returned a little over 6% annually, above and beyond inflation. And those 6% returns didn't require you to recognize Amazon's potential early or bet it all on some risky penny stock. All you had to do was be average and invested. $5,000 invested per year at 6% annual returns is worth $419,000 after 30 years. Of course, if you get good at investing, you can do even better. $5,000 invested per year at 7% annual returns, just 1 percentage point difference, is worth $505,365 after 30 years. The same at 8% annual returns is worth $611,729. So let's talk about how to invest in stocks. Here are the 5 things that you need to do to find and invest in great companies. Number 1, buy what you know. That's a quote from legendary investor Peter Lynch. Take a minute and think about what areas of business you know about. If you've waited tables, you probably know a thing or two about restaurants. If you're a medical professional, chances are good you know a bit about health insurance and hospitals. But expand your mind further than just your career or past jobs. If you spend a lot of time on social media, you probably understand on some level how Facebook, Snapchat, and Twitter are competing with each other. If you love to cook, you know who produces good cookware. I run and play volleyball in my spare time, so I know who makes good athletic wear. That doesn't mean you have to purchase any of these companies, but it does mean that you'll have an advantage over most other people in the market. Because of your extra expertise in a particular sector, you'll hear that a company is trying something, maybe rolling out a new product line, and immediately have a pretty good idea of whether that's a smart move or not. It's a huge advantage because you won't just take management at their word. And that's a classic mistake I see new investors make. They hear management paint a picture, and they assume that management is all-knowing and wise. You've got to be able to evaluate that independently. And a great place to start is by investing in stocks whose businesses you interact with regularly and really understand. Once you have the list of potential companies, the second thing you have to do is know what you buy. By that, what I mean is really understand the underlying businesses you're buying when you purchase a stock. Interacting with the business regularly helps you do that more efficiently, but it's just the beginning. Just because you shop at Walmart all the time doesn't mean it's a great business to invest in. You're betting money on a business model, so you have to understand it top to bottom. Fortunately, there are a bunch of free resources all over the internet to help you do just that. The Fool.com team writes nearly 3,000 articles a month on all kinds of stocks. Articles designed to help you figure out whether any one company is worth investing in. Most publicly traded companies operate an investor relations site. All you have to do is search Company Investor Relations in Google, and you'll find it. You can read how the company's leadership views their own company by reading their presentations and press releases. Then run that through your own filter and your own expertise. The Securities and Exchange Commission runs a website called EDGAR, just search for that online, you'll find it, that provides all of the documents a company has to file with the SEC, like the 10Q or the 10K. These are more ways to learn about each company you're investigating. The world's greatest investors read all the time. If you want to be great at picking stocks, it takes reading. The key questions you'll want to be able to answer once you've finished your reading: how does this company make money? How does it plan to grow? And relatedly, how realistic are those plans? What threats does it face? Does anyone else do what this company does but better? And how competent, experienced, and trustworthy is management? By the way, if you're enjoying this video, take a sec and like this video and subscribe to our channel. We want to make sure that you get all the best investing content. Rule number 3, buy the best. Okay, this probably sounds totally obvious at first, like, duh, why wouldn't I buy the best? But let me explain a little bit about what this means. It means company leadership knows what it's doing, is trustworthy, and, crucially, has a credible, low-risk growth plan for the future. It means a business has enormous demand for its products and services and provides the best version of them. Because if you can't compete by providing the best product, your only choice is to compete on price, slashing your own profits in an effort to stay relevant. Not a good place to be. But beyond that, you want a company in an industry that's poised to grow. Because even if the company's grand plans for growth don't pan out, a rising tide will lift all boats. By contrast, even the best company in a dying industry will struggle to grow profits. You see this playing out with newspapers. Businesses that build computers are fighting over a part of a pie that shrinks every single year. To sum it all up, it means buying a company that's set to grow and prosper in ways that you can't even yet predict because it's in a great position. Number 4, don't play meteorologist. I think that being a meteorologist might be one of the roughest jobs out there. Your job is to predict one thing, weather in the future, and if you do anything less than perfectly, you get blamed by everyone. It's easy to fall into that trap when picking stocks. You bet everything on one company whose future you think you understand, and it's way too easy to lose everything. Think about what we just talked about in principle number 3, buy the best. With each stock you put money behind, you have to guess how honest management is, how they'll respond to problems that don't even exist yet, and how the industry will change in the coming years. No one can predict the future 100% accurately. Not meteorologists, not me, not you. You can avoid falling into this trap by having at least 10 stocks in your portfolio. That way you aren't betting it all on the future of just one company. And that's not to say you have to buy them all at once. That would cost a lot of money. But you need to plan to expand your portfolio over time to at least 10. All kinds of studies prove out that portfolio diversification has helped investors lose less money in a market crash and make more when the market soars. So take advantage of this principle and make it work for you. Principle number 5, commit. This is the toughest of all. Once you buy a stock, you've got to commit. The day after you buy the company, its stock might drop 5%. Doesn't matter. What does matter is if you bought the best. The company, or even the whole market, might lose 50% of its value in the next year. Doesn't matter if you still believe the company's core business is strong. To be honest, such a drop might be an opportunity to buy more stock since you're getting a great business at a discount. But the key thing here is, if you've done your research and are so confident in the company that you're willing to put money behind it, you should be so confident that you're willing to hold the stock through its ups and downs for years. Of course, if it turns out management's been lying or the business collapses, you shouldn't blindly hold the stock out of stubbornness, but you shouldn't sell it because the stock gained or lost 20% in the last month, because the real key to winning the stock market is long-term investing. It's the key to the entire process we just talked about. You're going to make some bad stock picks. Every investor does. But you can win the stock market by letting your winners run for years and years, making you money while you focus on other things. So once you have a great idea, commit to it and see where things take you. Do you think we left something important out? Which of these 5 do you think is the most important? Comment below to let us know. Investing done well takes time, but it can produce incredible gains for your portfolio. Now, it may be that you don't have the time to devote to investing right now. Work's crazy, the house needs repairs, whatever. If so, here's a video that shows you how to invest in index funds, which give many of the same benefits of investing in individual stocks and require a lot less research time. But before you head over, like this video so we know you loved it, and subscribe to our channel so you don't miss out on future videos from our team.